Welcome to Total Money Management. Like I said last week, we're going to be focusing on a bit of a 2024 review and an outlook for 2025. As usual, I'm sat here with Steve Moriarty.
How are you, mate?
I'm well. Yeah, I'm good. I'm looking forward to getting overseas. I'll be overseas now, actually. When this is out, I'll be in France. So anyway, I'm looking forward to it.
There you go. Yeah.
So let's kick off with Howard Marks, one of our favourite investors, but he's not in equities now, is he? He's in...
He's mainly in credit.
Credit, that's
these days. He hasn't been in equities for a long time. But the reason why we put that on there, which was a good choice, Jacob, is the thing that you have to worry about is the thing you haven't thought about. And it's what we talk about with, it's always the unexpected event that gets you.
Yeah.
By its inherent nature, you don't know what's coming. And what Howard is saying is it's the things that you haven't thought about, which you need to not think about, but they're the things that are going to catch you out.
Yeah, well, you're never going to know. You can plan till the cows come home.
Yeah,
and
yeah.
It's the thing that you didn't.
Well, the
plan for, right?
market talks about things being priced in, right? Yeah, we know about the war. Yeah, we know about that. Yeah, we know about that. It's the unexpected events, like the hurricane blows through Tokyo, or what fires in
LA.
Yeah, fires in LA or something. Right?
Drones in New Jersey.
Yeah.
And the rest of it.
UFOs somewhere only in America though.
Yeah.
So that's the vibe.
Yeah. But moving on, so we want to review the global markets update. Then we'll talk about the US, how it's performed, and some. I won't use the word predictions. That's a naughty word. And a bit of an outlook, and then. We want to get into some strategies for 2025, what we're looking at and what we think people should look at, which I think will be really interesting to run through as well. But I'll hand over to you for a markets update.
Yeah, just I'm glad you've showed that because I can't see it on mine. We talked about this, I think, last week. But again, just showing you the returns, folks can look at that themselves, just wheel it through. What, as we said before, is it's always, we like to look at the things that have gone down or have negative returns. Commodities we talked about, because that's where you'll get something that's underpriced.
Yeah.
Right? Where you can make outsized returns. So that's a pretty straightforward one. That is, we've talked about the last few weeks, Jacob, about everyone's in the tent in the US. There's a visual. I think that pretty well gives you a bit of an idea about it.
65% and then 5% down in Japan.
Yeah. So, it's again why, we've sort of been voicing concerns about the US market.
Yeah.
That's really crazy. Number of all-time highs. Again, look at from 13 onwards. A couple of things I point out here. Now, notice from 2008, there were no all-time highs from 8, 9, 10, 11, 12, 13. Now, what I'm showing there is, and if you look at 2001, 2, 3, 4, 5, 67, 68, 69, 70, 71, those years where it says zero are the years that it spends getting back to where it was before.
Because they're usually after a crash, right? You got 1970s.
Exactly.
Yeah.
Right? So what it's saying is the market crashes in 07, right, 08. It takes 5 years to get back. It actually got back to, I think, in about 2014. Yeah. But the point is you spend 5 years, right, a lot of years getting back to the previous high, right? Now, if you have a look at from 2013, right, 52, 38, 6, like you've had a really, really big stellar run. Right? And if you have a look at any of the other big stellar runs, 1990 to 2000, right, this has been one of the longest bull markets. And in fact, I think it is close to being the longest.
Yeah,
so
it's just got to be the 1990s to 2000s bull market, and then we're in.
Yeah. So simply saying there's probably going to be a bit of red hit that chart over the next few years, which is, what you want to have a look at.
Yeah.
We talked last week about margin debt, and we talk about this again, just showing the correlation between margin debt and the S&P 500. More margin debt, the S&P grows, right? Again, more money in property, house prices go up. pretty standard stuff. Just showing you again a bit of a long-term view. You'll notice how margin debt's really shot up from about 2022. That was the post-COVID stuff. Right,
so just government's chucking money and everything.
Yeah, well, it's just the stimulus. What do they call it? Stimulus checks.
Yeah.
And the other thing is the Feds. The rates have gone up, and what people don't realise there is they're paying more money in to the bondholders who are going on to spend it.
Yeah. Right. Okay.
Right, so there's a lot of luxury goods doing really well, and the reason why is because the wealthy have got millions in bonds, and they're getting 5 and 5.5, right? So they're going, beauty. This is, I'll go and spend it. But again, just it's another valuation tool where you just look at it and go, that's funny. It falls a lot when in those periods where the cape is high.
Yeah.
Right. You look down there. You got 2000. You got 2007. You got 2021. Which was COVID,
Yep.
Right? So, again, you see that when the cape's really high, and then you look at it from here, from the bottom of 2009, it has a really great run to about 2019, right? And then it has COVID, an absolute crazy spurt upwards.
Yeah. So, basically, when the money printers are on, everything's
when people are in there borrowing on margin and putting it into the stock market.
Yeah.
Right, and that's what's going on.
Banks are lending and everything like that.
Yep.
Next,
that's just the inversion. So all I'm doing there is showing you, like that previous chart, just going when the margin debts are really high, the S&P goes really high as well, but it's inverted. So again, like I said before, when the when the ratios are really high, when margin debt's really high, the S&P's gangbusters. When margin debt's really low, the S&P's usually pretty low.
Yeah, okay. That's good to know. And moving on to Aussie market update.
Yep.
So we don't really spend a lot of time talking about Australia, and it's for good reason, obviously.
Yeah. The US is, like we showed on that slide, but the US is an enormous... The US is now at 65% of global market cap, right? Now, the economy for the US is about 25% of global GDP. Okay, so we got a big out of whack there.
Yeah.
But, yes, just again doing the Aussie market there, again, I won't spend too much time on it, but the year-to-date was about 11.5%.
Yeah.
It's been okay in the Aussie market without being spectacular. And, you can go through the sectors. Again, if you have a look there, Jacob, you've got energy, materials and consumer staples have had a negative year to date. So that was last year. So, again, there's some value in there in energy. But
commodities.
The banks are really expensive,
Well, that was an interest. I hadn't actually thought about it. You mentioned it last week where obviously it's heavily weighted, the ASX, by the bank stocks, similar to how the FANG stocks and Magnificent Seven weight the US equities. And if something happens in real estate in Australia, which, I'll get inundated with messages now about how it will never happen, but that could really affect the ASX.
Absolutely.
Big time.
Absolutely.
It's all connected.
That's why I'm concerned about the US, because if it goes down, everyone else is going down with it.
Exactly.
Right? We may not, but I wouldn't want to be betting on it. As I said, I think we talked about CAPE in the last week. Australia's about 20, average 17. So, a little bit, 15, 20% overvalued. But it's, again, if it falls, it can go back to, CAPE of 12.
Quite easily can go to single
absolutely.
digits. Next up, we have headline sector contribution.
Yeah, just again showing, financials booted it out of the park. Materials, energy, consumer staples down the bottom. So again, what we're saying is that's where you should be looking. Yeah. Right, consumer staples, energies and materials.
Yeah, so some issues being budget deficits, low deficits leading to low returns.
Yeah. If you think about 25 or from, here onwards, one of the things that, as I think we mentioned a couple of weeks ago, was, this idea that government should be like households and should be in surplus. And what I'm saying is if Albanese and Chalmers have low deficits, we're not getting a lot of growth in the economy, right? It's because, again, they're relying on the private sector and they're relying on business to borrow. Well, why would business borrow if consumers are borrowing, but they're spending it all on mortgages. So nobody's got any, I shouldn't say nobody, but there's less money floating around the economy because everybody's trying to get ahead.
Yeah.
And if Albo is not spending a lot of money, well, there's less money floating around. So you've got to consider that, right?
Unemployment in Australia is pretty good at the minute. I haven't looked at the recent
Yeah,
figures.
it's low, but my argument, Jacob, is it's no longer a good indicator because in the old days, when you had a 9-to-5 job and you were unionised, unemployment was a good indicator because people had full-time jobs and they were out of work, right? Now, people have got 2 and 3 jobs. Yep. They're working 20 hours. They're not getting enough money. So they're not unemployed, but they're bloody poor as buggery.
Yeah.
So you say, unemployment's low. And it's like, I know, mate, but they're all Uber drivers struggling.
Yeah.
You see what I mean?
What's
it's
the
sort
real
of,
figure?
it's very misleading and I don't pay attention. Oh, well, I shouldn't say I don't pay attention, but it's not an indicator of the health of the economy. Right?
That's a bit outdated.
Absolutely. So next year, that one, election, general policy, uncertainty and potential change of government. Albo gets the flick and we get Peter Dutton.
Well, that's this year, right?
This year, sorry. Yeah.
November.
25, yeah.
November or something.
No, they've got to go by May.
Oh, is it that early?
Yep.
Yeah, right.
So companies will hold off investing until they see it. And because the election 50-50, they'll be looking at it saying, well, hang on, we might get Peter Dutton. Why would we spend money now if Dutton has a different policy, particularly around energy?
What are your thoughts on Dutton getting in?
Well, I think, people on Labor side of politics go, Peter Dutton's unelectable. No, sorry, you're wrong. We all thought Tony Abbott was unelectable. Right, and he got in. We all thought Scott Morrison was unelectable. We all thought Donald Trump was unelectable. So Dutton is a big threat. I'm not making predictions, but it's going to be very close, right? And from my perspective, it's really late in the game for Albanese and Chalmers to start throwing money at the electorate. So I suspect they must be thinking it'll be down to the campaign and what we promise people to come. But because I think if, put it this way, if he said to me, oh, Steve, steady lever, I'd be going, Albo, inflation and house prices. Did you see what happened to Joe Biden? He didn't talk about inflation and people punished him for it. And their economy's going gangbusters. Yeah. Well, we got the same problems here, and that's why I think it'd be different if you said Peter Dutton's got 3 heads. Oh, well, it doesn't matter what Albo does. They're not going to elect Peter Dutton, right?
But it seems to be as a general sentiment that people want to change your hands.
Well, the argument I put these days, Jacob, is, it's always been this, they never vote governments in, right? We're not voting Peter Dutton in, we're voting Albanese out, right? Because most people go, oh, I'm doing all right. Yeah, okay, well, yeah, we'll put Albo in. Right, he's all right. But if people are saying, man, I'm doing it tough and, I still haven't got a home, Doritos are still $5 a packet, bugger this, I'm going to vote for Peter Dutton.
Interest rates are through the roof.
Well, if Dutton says, you can use your super to buy houses, even though they're stupidly priced, people will say, there you go, I got enough in there, I'm going to do that.
Yeah.
Right? Yeah, so, Albo's promised to build 1 million houses or something. So... but just a couple of other points back there, mate, quickly. Sure. US market contagion, we talked about that one, right? Housing decline. If houses start declining, and again, we talked about this, I think, a couple of weeks ago with the release of, John Howard and Peter Costello going, man, we don't want to touch that. Albo's in the same spot. Now, the problem will be, if prices keep going up, landlords are going to say this is great. Renters are going to say this sucks. I hate Albo. If prices start going down, renters are going to go, great, I can get a house, and the landlord's going to go, Albo sucks, right? So that's why I say you just look at it and go, best of luck, Albo. Mate, you're on your own. Don't come looking at me. They know we know what's got to be done. They don't want to do it, right? It's as simple as that, right? So what do we got the next one? The valuation.
I wish I felt sorry for him, but I don't, unfortunately.
Look, it's been a long time coming, right? But politicians end up losing because they don't do what they've got to do and what they should do, right? You just ask people on Twitter, mate. They know what to do.
they're all experts.
They're all experts. Of course, none of them have been elected. Strange about that, but they all know what to do. Righto. Okay, just the equity valuation.
Yeah.
Australia's reasonable. PE's 18.4. It's not too bad. Dividend yield's okay. 4.5.
What's the highest Australia have been on ever, Cape?
31.
Really?
Yeah, in 2007.
Wow.
I was quite surprised, but I think that was mining driven.
Right. Yeah,
Right?
well, obviously.
But yes, we got up to 31.
Hell.
And that's partially why we've spent a long time going down,
And so
because we were quite high for what we were, right? So we have to spend all that time going back down
I
again.
didn't know that. Interesting. That actually makes sense.
Yes. So dividend yield's okay. Price to book, a little bit high. The price to book's probably a bit high because of the banks. The banks are really overvalued. That's why I think, if we get lower lending, we could be in trouble all around. This could be our GFC, houses and stocks go down because the banks are really overvalued and over leveraged into the housing market.
Yeah. It's something I had never thought about. Are the banks still paying a decent dividend?
Yeah, they're okay, but they're a lot. The PE of Commonwealth Bank, I think, is 27.
Right. Yeah.
So the average is 15. It's a long. Now you can argue they've got growth, but okay, kind of. The economy's the economy's nearly in recession.
Well, their projected growth is based on people being able to pay their bloody mortgages.
Yeah.
Right? Because what's their residential mortgage? Is like 60 or 70% of their...
60% of the loan book's in bloody mortgages.
Yeah, so...
Man, that's crazy.
Yeah. So if people... Well, we're seeing it. People are in tight squeeze. They can't pay their mortgages back. They're in a bit of a predicament. Anyway, I'm not being all doom and gloom. Next.
What do we got?
Oh, issues.
Righto, drum roll.
25 issues.
Thanks, 24.
Yeah. So what are we looking at for 2025?
Righto.
So dangers, what's good about 2025?
Yeah, as you know, we sit down and split this up into the good and bad bits. So, and I must say, it's often where you get to the end and people go, well, thanks for nothing, right? Because they're going, well, okay, tell me what's going to happen. Oh, well, one hand on the other hand. So I just thought we should list them out, right? So COVID is coming back again. There's places in the States that hospitals are saying you need to mask up. We've got animal flu floating around.
This new thing coming out last week.
Yep.
Or so.
Okay. So that aside, from the bout of COVID that we had, we've got a lot of long COVID, right? We've got and there's a lot of growing concern about the effects of long COVID, particularly on unemployment. And if you couple that with demographics, we may have a shortage of staff, which means higher wages, inflation, right, and potentially lower stock markets, okay? Immigration, global issue, it's a real problem. That's a potential fuse. But again, the reason why we're letting in immigrants in really big numbers and foreign students is simple. We want to give them residency so they either stay here or they can come back here and work, right? That's what it's all about. It's about demographics, right? There's arguments about cheap wages and, staff shortages or skill shortage, which I think a bit of bullshit. But the point is it's a long-term strategy and other places are doing the same thing, right? Because they know the demographics are bad. But you could not go to the electorate and say, we've decided to let in 1 million Chinese and Indians. The Australians would go, hey, hang on a second, right? And it's a real issue. Yeah. But we let in foreign students and we say to them, you can come here and study, quote unquote. Oh, you can also have a job too if you like.
And they're paying like 3 times more, don't quote me on this, more than an Aussie
Yeah,
student.
they're paying a lot. Yeah. But they're working.
Yeah.
They're all in the coffee shops, mate, right? So that's another one. Reduced numbers means potentially higher wages, right? And this is an argument globally over the long term, not just for 25. Rising inflation, right? Staff shortages, lower company valuation and dividends, okay? War, higher oil prices, tariffs, protectionism, leads to higher inflation. We've got all that going on anyway.
Yeah.
We haven't got higher oil prices, But that, I think we discussed a week or two ago, is a bit of a fuse.
It could tick.
It could tick over and things, we find ourselves at $100 real quick, right? Trump, general uncertainty around Trump. He's fairly unpredictable. Lower deficit spending due to DOG, which is the government of the Department of Government Efficiency, which is Musk and Vivek Ramaswamy. I don't think that'll happen. Elon Musk is now walking that back. He's now going, well, they can't, mate, they can't pull $2 trillion out of the economy. They'd have to cut military spending, Medicaid, Social Security. No.
So just talking out of his ass, basically.
They'll probably have they might have a couple of victories and it'll be token amounts. But on the other hand, they could say, right, we're going to slash Medicaid or something, right? But all of that the problem with Trump is the uncertainty about what he and his team are going to do, right? This is not situation normal, continuing on, continuity, bureaucracy, right? RFK's, talking about taking fluoride out of the water, and he's coming up with these things about vaccines and all these bloody conspiracy theories, right? He's going to go after pharma companies, all this sort of stuff. And that's the stuff that business don't like, right? Because like I said to you with Albo, if Albo looks like going, will business say, okay, well, we better wait till Dutton gets in and then we'll talk to the new government, right? Well, with Trump, they're going, oh, man, we better wait to see what these idiots are going to do, right? And it's a hard one.
It's a bit of a stalemate at the minute.
Yep. And the last one is the vicious reversion of the Magnificent Seven. And
because that's not going to, if and when it comes down, that's not going to come down politely.
Probably not. Yeah, probably not. It'll reach a point where there's panic.
Yeah.
Right? That's what'll happen.
The retail investors will be left with their bloody pants down.
I think, and we can talk about this more in the future, I think AI is largely bullshit. I think AI is what the internet was in the 90s. It's going to solve everything. From the stuff I've read and as we talk about disconfirming evidence, it's got a heap of issues. And I think it's going to set up it'll be the thing where they go, what do you mean we spent $10 billion and we're not going to get the return? And, there's going to be a heap of problems and that will be zoot. Yeah. Then that's when the market will go, this is garbage. And, there'll be 3 players left at the end. Okay, the good bits. Okay, Trump doesn't care much about budget deficit, so he'll probably throw a lot of money. He's also got tax cuts, so that would be good, right? Yep. The US economy is really strong. Labor figures came out this week. They're really strong. They're spending a lot of money. They've got an investment boom, so that could well continue on through 25, right? And most likely will, but it doesn't mean the stock market will go gangbusters.
Yes, right. Because the stock market is not the economy.
Yes. There's particularly when the Cape's at 40. But can it get to 44? Yep, sure. 45, 50, sure. But it just gets uglier after that. Europe and emerging markets rebound via commodity prices and government spending. The governments are spending more now, other than Albo, of course, but generally higher defence spending in Europe. They're going to, and emerging markets, they're going to have to start spending a lot more because they can no longer rely on America. Right. More lending. As we showed, I think, last week, American public are not that highly indebted, so there's plenty of room to expand lending. Higher budget deficits, Trump tax cuts, right? So, they still might be partying on, more confident in the US in 25, even if it's Trump and, crazy shit happens every week.
Yeah, I mean, it's likely the economy will continue to do okay.
Yeah.
To your point before.
Well, recessions are 2 quarters of negative growth, right? Well, they're growing at about 3% real. It's pretty unlikely you wake up next quarter and go, oh, now it's negative.
Yeah.
That's the first quarter. It's like, it's going to take a while yet. And because Trump is a populist, I think it'd be like, righto, give him some more money.
Yeah, do whatever it takes.
Yeah. Just, expand the budget and blow it out of the water again.
Yeah.
So higher profit margins from Trump's tax cuts. That's an important one because profit margins for companies historically has been unbelievable. That's why they're making so much money, right? Because a lot of it is not going to labour, to wages. It's going to their shareholders. And that may well continue because Trump is going to extend his tax cuts and more stock market gains, right? So, the joint just keeps jumping.
Yeah. Anyway, well, it feeds into strategies because we've all made a shitload of cash in the last 12 or 24 months or so. So what do we do? Right? What are some options? And obviously, listeners, don't be daft. This is not financial advice.
Yep.
Don't go and lose your pants.
Yeah, I think, look, there's two. The US is really overvalued. So it's difficult to see where you can make a lot of money in the latter stages of a bull market, okay? But bull markets in the latter stages generally have a melt up, right? Yep. We've had 2 years of 25%, so, we're pretty much melting up.
We're melting somewhere.
Yeah, we're melting something. So that's the broad global view would be the US is expensive, be careful. But as we say, well, hang on, there's, Brazil, Mexico, Poland, England, they're all cheap. Okay, well, then the next question is, as I've set up there, the question is, how should I be allocated and how can I make sure to capture as much as the capital gain portion before it mean reverts, okay, given the market cycle and CAPE valuation? Okay, so that's really what people want to know.
How can I hold on to my cash?
Yeah, what do I do with my money? Do I put it all in? Do I put it all out? How much do I put in? How much do I put out, right? So what we're talking about below that is the strategies that you can do. So we talked about this, I think, a month ago, saying you can rebalance more often, right? So if you make a profit, take it. If you make a profit, take it, right? Because inevitably you know that there's going to be a point where it turns down, okay? Okay, so that's the first one. You can rebalance every month. Okay, second one, you can use the 200-day moving average, right? I'm all in, but if it hits the 200 on the way down, I'm out.
Yep.
Now, if you get a whipsaw and it goes back up again, well, get back in again.
Yep.
So again, when the market's expensive, what you want to do is use a shorter duration, right? Like well one, right? Hit well one, just ease up a little bit on well two and well three, right? So that's the idea. The next one, asset allocation. Okay, potentially good short term for bonds, although now this week the labour data in the US was really strong. So they're now saying, and now the US market, what date are we on, Jacob? The 12th, so that would have been the 10th. Friday the 10th, the US went down about 1.3%. And this is the perversity, right? The perversity was because the US economy is going great. And they sell stock, right? Now, the reason why they're selling is because they're expecting rate cuts.
Okay, right.
Right? Now, when they come out and go, no, the economy's going gangbusters, we're not cutting rates. In fact, we might need to raise them. That's when they go, uh-oh, right? So that's where I'm saying that you need to think about bonds, okay? The reason why is because people are saying, oh, the rate cuts are coming. If they're not coming, well, bonds will actually be not a good place to be, okay? If the economy then sinks, interest rates will be cut and bonds will be a better investment. The US is going really strong. There'd have to be some sort of, again, unexpected event where Powell needs to cut rates. Trump could get rid of Jay Powell and get someone in there and he says, just bloody will cut rates, right? They can do that. But if they do that, they may overheat the joint, right? Okay, hedging. That's a really big one. So let me do the next one. Term deposits, boring but safe, okay? Stick your money in the bank. You get 4.5 or you get 5, right? You're not getting bloody 45 million in Bitcoin. You're not getting 35,000 elsewhere. But there'll come a time when you'll be able to deploy it and get more.
Save, and then compound it at a higher rate.
Absolutely. Wait for the fat pitch, right? Okay, get back to hedging. Okay, so you can say, as we talked about, you can say, well, the market's gangbusters long. I'm going to go short, right? Or you can hedge your portfolio, which is saying I'll buy some gold, right? I'll buy some Bitcoin and I'll buy some short ETFs, right? Or put options, right? But the whole point of hedging is saying, you imagine if you had $100, right? Now, if you said to me, oh, Steve, the market's going gangbusters, but I really want to, I don't want to miss out. What I would say is, and I'm just using this as an example allocation, I might say to you, well, I'll tell you what, Jacob, put 95% of your money in the S&P, right? Even though the Cape's at crazy levels. With your other 5%, go and buy a short ETF or out of the money puts. And what you're doing then is saying, well, I'm going to get the good part because I'm mostly in the I'm riding the upside. But if what hits the fan, my short option will rise really quickly. My long portfolio will come down, but I'm partly hedged. So in other words, if the stock market drops 50%, but your put option or your leveraged ETF goes up 25, right, for argument's sake, you go, okay, well, so I'm not down as much as I would have been had I had all my money in the long. You
soften the blow a little bit, and you can work out the formulas where you go, okay, well, over the last 4 crashes or so, it's come back between 30 and 40 to 50%.
Yeah.
How much of a put option every year do I need to buy to offset that and the maximum amount?
Yeah.
Or a leveraged ETF, or whatever you want to talk about. Rather than just going, okay, well, my put option's up 10 zillion, but it's only worth $1,000, and I've actually lost 200.
That's what I mean. Yeah. You've got to, and look, that's more art than science as well.
That's right. Yeah.
At our level. Now, the professionals can do it differently because they can study all the volatility and all that sort of stuff. But generally, what you're doing with hedging, and the way to think about it is insurance, right? I've got a really nice car. What happens if I have a really bad accident? It doesn't matter if I have a little ding, right? If I get a little ding, that's okay. But what happens if I run into a Rolls Royce? Well, I really want to be insured. That's what you want, right? They call that tail risk, okay? The catastrophic event where, an earthquake hits Tokyo, right? Wipes out that and everybody goes crazy and markets go crazy.
Yeah.
Right, that sort of stuff.
Okay, so we want to be making sure that it's more, what we're saying is shorter term strategies of the next chapter. Generally
dance close to the door.
Yeah.
Right? If you do really well in the short term, take the profit, right? Who was it? Bernard Bryce said, I got what did he say? I got rich taking a profit or something. I.e., listen, if you've made a bit of money, we'll take it off the table.
Yeah.
It could double, but it doesn't matter. Just continue to make the money and avoid losing the money.
Exactly. Yeah.
Right? We always say that. Just avoid losing the money. And you lose money when you risk it too much. Right? When you push it too hard and go, I'll just wait. Right? And then when it starts falling, which we're going to talk about in the next session, your brain starts going, it's actually a buy the dip opportunity, right? It's like, no, bro, it's not.
Not this time.
Not this time, right? The Cape's gone from 39 to 35 and you go and buy the dip. It's like, nah.
Yeah, I mean, even with Bitcoin at the moment, it's tracking the S&P 500 very closely.
Yes.
And the equities market very closely. So generally, I'd say we'll hedge it with a bit of Bitcoin, but at the minute, I'd say no.
Well, as we said, 2022, Bitcoin dropped a lot when the S&P dropped. Yeah. So these correlations can be really tenuous, right?
Well, the cash is just sloshing between all sorts of Bitcoin, gold, silver, equities.
Precious metals and that sort of stuff.
Yeah.
Righto.
That's it, I think. If you have any questions, as always, reach out. We're happy to answer anything over the next few weeks, particularly if you have specific questions about how we do things as well. We'll want to, I think. Thanks, Steve.
Cheers, folks.
As always, remember, we don't provide financial advice.